All right, we are recording. What's up, everybody? My name is Juwan Rohan. This is the Misguided Podcast where we intend to guide you to a better future. I'm sitting here with the homie Joziah. What's good, bro?
What's going on? Thanks for having me.
Of course, man. It's always a pleasure to have you. Today, we are going to do an educational segment. We are going to talk about retirement. Now, what the hell is retirement? For those listening, well, you're about to find out in the different types of way you can save for retirement. Let's just start off with the basics. Is retirement good? Should everyone do it? Is it for everyone?
Definitely, I would say. And retirement, basically, what people know for retirement is just your 401k with your employer. And what
True.
that is a way to save for retirement without really having to go and buy these different retirement, I guess, products on your own. So with the 401k, I guess I'll start with that first. What it is a way to defer paying taxes on income and to save for retirement and gain compound interest in for your future, really. So what it does is, let's say you make $45,000 a year, right? And you put $5,000 out of that into your retirement. So now you'll be taxed on $40,000 instead of $45,000, and that 5,000 will go to your retirement account. And then so that's what it is for like the quick, I guess, basic explanation. And is that pretty clear?
Yeah, but what happens when I put that money into the account? Like I just gave who $5,000, and what is the $5,000 going to do over time?
So it goes into your retirement account, and like I said, the 401k is the most basic one, and it's pretty much taken automatically out of your check, so you don't even see it. So you select a percentage to go into your 401k. Let's say it's 5%. So that 5% will come off your pay right away, and then you'll pay taxes on the remainder of that paycheck, and then it just keeps building up, and you have to leave it into your retirement account until you're 59 and a half, and then you can access it.
Got you. Got
And
you. Okay.
before that, you have to pay like early, withdrawal penalties, and then
Yep.
you have to pay taxes on top of that, because you didn't pay taxes on it while it was growing.
Yep. So I got this money. I put it into an account. Actually, it never even comes to me, right? My job, whoever I work for, let's just say I work for Zoom. Zoom sponsorship Zoom. Zoom pays me, right? And then on the check, your pay stub that you get, you'll see that if I chose 3% to put into my retirement account, 3% out of my biweekly check goes into that account. So I never really see it. What is this account and how, like, why, what's the point of investing in it? Like, this account is just sitting there.
Yeah, so it's a lot of reasons to invest in it, but what it is basically is, like I said, it's a retirement account. It's so you don't have to work or teach until you're 75 years old. You don't have to work until you're 65, whatever the case may be. It's to
True.
invest into your future, because you can't work forever, but you do need to live. You do plan on living for longer than you want to work, obviously.
How much
So
control do I have over this account?
you pick the funds. You can have, like, if you're starting to invest later, which I hope no one is. You might pick some more conservative investments that's not as risky. But if you're starting early, one, you're going to gain compound interest, and two, you can be more risky with your investment. So you can pick some of those, high risk, high growth options in your portfolio. And when you go to it, you'll be able to select like a bunch of your own mutual funds and stuff like that.
Hmm.
And it's pretty much like a target date fund. So if you're 29 right now, or 20, let's say 29 right now, you won't be retiring for another at least 30 years, probably closer
Yep.
towards 2050. So you have a
Yep.
2050 target date fund, and then you have more aggressive options.
Yep, very true, very true. Now, when investing in these funds, let's explain to the people exactly what they're investing in. So you said products earlier. What is products that you're talking about? Is it stocks?
A 401k is stocks, but it's like a bunch of mutual funds. But I don't want to get into detail of that, because you have to go to like your financial advisor. But from my perspective, and what it is basically, not basically, what it is three options. So you can either go for a traditional 401k with no company match,
Yep.
and then you can have a 401k with a company match, and then you can do a Roth. All are beneficial. All use the same deal. You have to wait until you're 59 and a half.
Yep.
But it's three differences. So with the 401k, um, It's no company match. You take it directly out of your check. You don't pay taxes on it right now, but it grows with compounded interest, and you pay taxes on it when you withdraw it. With the 401k with the company match, so basically, like the industry averages, they'll usually give you like between 4 to 6%. And what it is like because companies do want you to save for your retirement, so you're not working forever. They'll match it. So let's say you put up 10% into your 401k out of your check, they'll match up to 6%, which is free money, which is
Yep.
also I think the best option. And the third, what I mentioned was with the Roth, is it's already taxed. So instead of it coming out of your check and you pay taxes when you withdraw it, it grows tax free and you pay taxes now
Yep.
and you withdraw it without having to pay any taxes when you hit that retirement age.
True. So pretty much Roth is, when you get your pay stubs and you see all the goddamn taxes and disability, all that stuff that they take out, all the deductions. When you invest in a Roth, they pretty much take those deductions out right then and there. So it's based off of your whatever you get paid biweekly, whatever percentage you invest in, they'll take it out right then and there. And then whatever money they transfer to your retirement, your Roth IRA, that simply just grows. And then when you turn 59 and you take it out, you don't pay any taxes on it, which is a huge benefit to people because a lot of people forget that, when they turn 59 and they're like, oh, I have this much in, they forget that they're going to have to pay a huge ass, tax, tax thing when they take it out. So I love the Roth. When I found that out, I started investing a lot more into the Roth than the traditional. But then when I was working at Coca-Cola, they did match up to 6%, I want to say. So I was obviously, like you said, that's the best option. Max that out. But once you max that out, I think you should put all your money into the Roth. Wouldn't you agree?
That's exactly what I was about to say.
If they offer, not all, I don't think all employers offer, but definitely.
Yeah, not all employers offer, but you can set up like accounts with like
True.
John Hancock. You can go to like any of your brokers and set
Yep.
up a Roth account. But what he said is completely true. The match is always the best option because it's literally free money.
Free money,
Like
bro.
it's not your money that you're investing. It's a match from your company. And a lot of times what they'll do is they'll incentivize you to stay with the company. So they'll say they'll match up to 5%, and then you have to stay with the company for maybe 2 years, 3 years. And
It's
then
called, yeah. Oh, I
and
was
then
gonna
once you
say
stay
it's
that
called. Oh shit, my bad. Bro. I was gonna say it's called vesting. Just for
okay.
those, yeah. I want to get people familiar with terms. Just so when we interview everyone, and they drop these terms, people know. But yeah, vesting is pretty much they give you an incentive to stay with the company for 2 or 3 years, and they'll match you. And then if you don't stay with the company for that long, you don't get that money,
Yeah,
right?
that's
But it wasn't your money in the first place, so.
That's right. That's right.
Yep.
That's why when you're going to look at those statements, you'll see a vested balance and unvested balance. The
Facts.
unvested balance is what you put in there, but they'll show the vested balance because that's what they're matching. And once you hit that 24, 36 months or whatever the requirement is, you'll get the vested balance on top of that. So that's the best option I'll say for the match. Um, and then after that, the Roth is the best option to me. But you can only put up to $6,000 per year into your Roth until you hit above 50, and then it goes up to $7,000 per year.
True.
Because it grows tax free. They know it's a better deal to have your money growing tax free. That's why they put a limit on it. And then I think the number for the 401k is like 19.5, like 19,500 or something like that. And then it
The
goes,
limit.
yeah,
Yeah, you're right. I don't know what 2020 is, but that's probably right because in 2018 it was 18,500. So you're probably exactly right. Probably about 19,000, which huge difference. But they want you to do that one because they're gonna get their money back. Government as fuck.
the same thing. Once you hit 50 or above, it goes up to like 22,000 or something like that. So they do
Good
give you
job.
like
Yeah.
to catch up if you do start investing late. But the whole benefit of investing is to start early and gain compound interest because the same way interest works against you for like student loans or a car loan, if you have a bigger balance, you pay more interest. If you have a smaller balance, you pay less interest. Same way with your 401k. If you have a bigger balance, you get more interest. If you have a smaller balance, you get less interest. So it's better
Very
to
true.
grow it early, get a
Uh,
big balance, and let it work it for you.
Speaking of loans, what happens? Like, what if emergency happens and I need to pay a medical bill? Um, am I ever able to touch this money without being penalized?
Yeah, they allow you to take loans against your 401k up to 50% of the balance, or I believe the max is like $50,000 or something like that.
Yeah, I think it's 50%. And then
Yeah,
yeah, 50, yeah.
50,000. That's right.
Yep. Yeah, I think so. I think so.
Yeah. So, like I said, I would talk to like a financial advisor because this is all coming from personal experience and
Yeah.
investing.
We do not work for any financial company. We have just done a bit of research. So don't
Yes,
sue us.
I would say never take a loan against your 401k because you're literally taking away your compound interest when you do that. Because yes, you do pay yourself interest back, but that's money coming out of your pocket. That's not your money working for itself.
For
It's you
you. You're
paying
working for it.
exactly,
You might as well just go take out a loan.
exactly. You might as well take a loan to be real with
Yeah, probably just go take out a loan.
you, or invest in percentage into a HSA. I mean, a HSA, a health savings account.
Yeah.
But I'm not
I,
too
I don't really
versed.
like those. I don't really like those. What
Yeah,
that should be another episode. HSA and FHA. FA whatever. Yeah, yeah. But we should talk about those sometime. I don't really like them. But anyways, yeah, that's a great point. So you are able to take a loan out, and obviously you got to pay interest, and then you are able to, like you said earlier, get your money, but you'll have to pay. It's a 10%. It's a 10% what
10%
tap yeah penalty when you take it out right then and there, and then you got to pay like another 10% on like the taxes, like for like that you do at the end of the year or some shit like that.
Yeah.
um so you're getting double hit, so that's like you're losing everything, which is stupid. Never touch your 401k. That's what I always say. um
That's what
yeah.
I'm saying. With a
Very
line.
true. Okay, let's talk about, so what if I'm a teacher, if I work for the government, if I work for a nonprofit, is it the same 401k or what?
So it's the same exact thing, except for educators and nonprofit firms. It's called a 403b, but it works the same exact way as a 401k. And some companies are allowed to match it up to a certain percentage, just like a 401k. All because it's just encouraging you to save for your retirement, so you're not teaching or working for that nonprofit, for the rest of your life. They want you to eventually work to be free, So it's the
Yeah.
same thing. 401ks and 403s are the same thing. 401k and 403bs are the same thing. But as far as ranking, which ones I think is the best, I say 401k with the match, the company match, or 403b with the company match.
Yep.
Top tier. That's the number one because it's free money. It's literally getting money for free to save for your retirement, and it's no better situation than that. Second, I would say is your Roth IRA, because it grows tax free, and then just a regular 401k is probably third. But they're all good. It's all saving for your retirement. The earlier you start, the better. You're gaining compound interest. So whatever situation fits you, I would say go for it. But those are my three. That's how I rank them.
Yep. Okay. For sure. For sure. There's a couple ones on here. I mean, they're kind of low key because they're not talked as much about because they are mainly for small businesses. So I kind of do want to touch base on those because we're small business people and that's kind of what we advocate. There's a couple ones. There's called the Safe Harbor 401k. So yes, they're all 401ks, but they're kind of the way they're structured is a bit differently, right? So there's Safe Harbor, which is for small businesses, and those ones kind of they help you avoid time and all the money you have to go through with managing those accounts for your employers. So kind of what I was reading about, and remember, we're not experts, so if I'm wrong on something, I don't want to hear it. This is all just research, all right? But what I was reading about is that for the small businesses, these people or these businesses do not have to go through non-discrimination tests. All right. Now, what the hell is non-discrimination tests? I know I had to Google it too. Non-discrimination tests are pretty much like audits, right? From the IRS. So What it means is when say I'm the owner of a business and I want to give the option for a 401k to my employees, right? So I get to pick, which one I want to do. If I want to skip the non-discrimination test, it's going to be cheaper, more uh, it's going to be cheaper and less time to kind of manage. But the non-discrimination tests are pretty much like audits. So the IRS comes in and they make sure that you're being fair to all employees, and that you're not just benefiting, the ones who make 100K versus, 50K. The ones that make 100K are not getting better benefits in their 401k versus the ones making 50K. So that's what non-discrimination tests are. But yeah, like I was saying, Safe Harbor 401k plan is mainly for small businesses, and then they also have a couple other different ones. There's a solo 401k plan. It's mainly for like the entrepreneurs who are dabbling in many different things. There's higher contribution limits, so I think it's even higher than the 19,000 we talked about. And there's like a wide majority of investment options. So how you were talking earlier, you can be a conservative investor, you can be a moderate, or when you're young, a very risky investor, right? I think instead of having those three options, they probably have like 5 to 7, right? So it's just more balanced in your diverse ability. But let's see what else we got. um have you heard of these before?
No,
Bro,
I'm tired because I'm taking it in. I'm learning right now.
yeah, when like I was looking up shit, I had no idea there was like different types, like different categories in the 401k. So I was super crazy. um there's another one, simple 401k plan, right? It's another one meant for small business owners. The contributions are non-forfeitable. As soon as you contribute them, you cannot get them back. Um, these ones are for 100 employees or fewer, which is probably most of the people listening to this podcast. If you have 20 employees and you want to give them a 401k, this is probably where you're going to go. Simple 401k plan. That's what it's called. Like I said, talk to your financial advisors um, to make sure everything is correct. This one, they can match up to 3%, or they cannot. They can choose whether they want to. I found this one super interesting because this is probably everyone listening who have small businesses and employees, and it'll probably be the first when we hire employees. It'll probably be the first one we go to. So I definitely want to learn a little bit more about that one. But yeah, shit, 401ks, man, great investment tool. Now, there's a lot of people on YouTube who say, don't invest in your 401k. Don't do this. You should invest in real estate, or you should go out and buy some single stocks, dude. Airbnb is so hot right now. You know what I mean? What do you say? What do you say to those people?
Man, I say just follow what works for you. Personally, I think it's good to put all of your income to a percentage-based budget, so you're not, spending all over the place. Yes, invest in real estate. Yes, it's okay to buy mutual funds if you're into stocks, or single stocks if you know about
If you
companies.
know about it.
Stocks are risky. Stocks in general are risky. That's why your 401k goes up and down. Like my
Yeah.
401k took a big hit in March when the whole economy,
Everyone did, boy. I looked at that thing like, oh
right,
man.
and now it's up.
Yeah.
From what it's even past that point where it was. So it's a risk. It's a risk, but you gotta educate yourself. So I would just say educate yourself on what you're investing in. Don't invest anything. Don't invest in anything that you don't understand. If you don't understand it, you probably shouldn't invest in it. Don't invest just because you hear someone on YouTube or because you hear us say it. Like, go do your own research and come up with your own conclusion on why it works for you or not.
Very true. Very true. And if you've ever talked to a financial advisor and sat down with them, they'll tell you how good it is to diversify your profile. Right. So, my conclusion on this is don't just listen to the YouTube people. Obviously, sometimes they're great, sometimes they're annoying. But do your own research and really diversify your profile. Like you said, invest in multiple things. But before you just throw your money at something, learn about it a little bit. Shit, like we did, we just learned about more different 401k. So yeah, I think this is a great learning tool, and something you definitely should be knowledgeable on. I don't know why they don't teach this in school, but that's a whole nother fucking topic.
Sometimes
uh,
you gotta seek the knowledge and the information that you want, man. If I have to put a number on it though, if people want to like a number that I follow, I do 15% of
yep.
my total income of my household between my soon to be
Dave,
wife.
Dave, Dave, Dave Ramsey, baby, 15.
10%. It's safe because it's not like a big amount, but at the same time, it can grow to be a big amount, and that gives you flexibility to do single stocks if that's what you want. I'd rather invest in businesses outside of my 401k and real estate. But if you do want to invest in single stocks, if you do want to invest in Airbnb, if you do want to invest in a local Subway or start up your own franchise, whatever, you should do it within those parameters. I would say because if it fails, you do want to have something to fall back on. And a 401k or a Roth IRA, anything is good to fall back on before you do get to that retirement age.
Very, very true. One thing before we start wrapping up, go ahead and give your advice on when someone should pull and if they should pull. Not just talking about 401k, we're talking about any investment. So like you said, back in March, that shit dropped, right? Why didn't you pull? Go ahead and talk about that a little bit.
Because you don't lose your money until you pull out. Until you sell those stocks, that's when you lost money. If it goes down, as long as the company isn't bankrupt or coming up on going bankrupt, you won't lose your money. Like you literally can't lose your money until you sell it. So if you're going to invest in it, you have to have like the stomach to ride the wave with these different markets because it's going to go up and down. Like that's inevitable. Like it's going to happen. But
Yeah.
history of the stock market in general, it goes up every year from about 8 to 12%. So you can
And
ride it out. It's always worth it. And then in a 5 year period, it's gonna go up. So if you can leave
yeah.
it in for at least 5 years, I would say invest in it. And with the 401k, my advice is just to never pull it out. Like don't put more than you can afford into your 401k. Have you a nice little cushion. I'll say like 12 months. Save up like a year worth of like your living expenses, and then start investing into your 401k, and you should be safe. If you got that a year saved up, you should be able to get back on your feet in that time period. If you
Very
do that,
true.
so that's what I would
Very,
say.
very true. Very true. I want to piggyback off that and give it a little example and kind of go into detail about what you mean. So, for example, Airbnb just went public a couple days ago, right? Uh, they first started off, they thought it was going to be like $50 to $60 per stock. This is per share, guys. It ended up doubling, right? When they went public, and that evening, the price was 143, 145, somewhere around there, right? Right now, just got this morning. Robinhood sent me an update, and it's at 125. So it dropped $20, right?
Hey,
Now, I would be stupid as hell to have pulled my money out because it dropped. Like, oh, they're gonna just do bad, man. Like, I can't trust them. Why did I do that? Right? If I would have pulled my money out, I would have lost $20, right?
right.
Stupid, right? So, and we already know Airbnb is gonna be successful, right? Even with the pandemic, they've been doing good. Yes, their numbers have dropped, but they've still been able to stay afloat, right? And they've been, they went public. Now they have all these investors, right? So they're gonna be here in the next 5 years. So if I keep that money in there for the next 5 years, it's definitely not going to be at 120. It's definitely not going to be lower. Hopefully it's going to be, 200, 300, you know what I mean? So that's just a little example of like money wise, you could see it, see it on paper and stuff. But yeah, it would have been super stupid to pull out the money 3 days later.
Anything just about to dip. So your average of what dollar per share is goes down with it. So if it drops down to 100,
Buy
I'm
another one.
gonna buy some more.
Buy another one.
If it goes up, I know it's gonna continue to be successful. I'll
Yeah.
still buy some more because if you invest in single stocks and you know that company and you believe in what you're doing and you understand the business, and you'll have confidence in it. And you
Yeah.
got to ride that wave. So it all comes back to the education, man. You got to seek the knowledge.
Very true. Very true. Very true. Man, great episode. I think we did well in explaining for some non-financial advisors. I think we did well though. And if you have questions, guys, you know, hit us up. Give them your social media and everything. Where can they reach you, bro?
Yeah, you can reach me on Instagram, Twitter, YouTube at Brew City underscore Joe, BREWCITY underscore Joe, Brew City Joe.
For sure, for sure. And you can hit us up at the Misguided Podcast on all social media. You can email us questions, complaints, but I'm probably gonna throw that shit in the junk folder. But you can email us at the Misguided Pod at gmail.com. And man, yeah, what a great episode. Hey, to conclude this episode, I want to hear your thoughts on the Ashanti versus Keisha Cole. Who do you have winning next month?
Ooh, if they actually do it.
Yeah, she Shanti was being a little scary cat with that COVID situation. I
I
think she
feel
was lying.
I'm a fan of Ashanti, bro. I'm biased, bro. I love Ashanti, bro. I'm gonna keep it.
Okay, you're going to Shanti. All right, all right. Well, now that she bitched out, I'm sorry. I'm a Keisha Cole fan because I'm from the Bay. But who you got with the E40 and Too Short?
Ooh, me and my girl was just talking about that this morning. Um,
Yeah, it's like a huge topic. Like I'm actually seeing it. Well, maybe because I'm from the Bay, but and I follow a lot of Bay people, but I don't know. I feel like it's being talked about a
yeah,
lot.
my girl's from the Bay too, and she was just saying like that's a different era, so we're not gonna be able to have like the best insight. But from what I do know of Too Short and E40, I want to like for some reason I kind of want to say Too Short. But
Okay.
I, but I know more about E40, and I feel
Yeah.
like that's the reason why I think Too Short may win because I feel like he probably has a deeper catalog.
Too
I don't know.
Short, yeah, Too Short was rapping before we were even thought of. So like it's a different generation, but also I think just E40 has done a lot more for the culture. Like that's hard to say, but I think he's done more for the culture of the Bay Area than Too Short. Too Short did the bitch thing that traveled across the whole globe, but E40's just way of talking and like the water, 40 water, like just like his swagger just did more for the culture, I feel like. So I think he might take it, but hey, only time will tell, man. That's gonna be a big night right there.
All right, I can't wait for that one.
Facts, facts. Hey, well, I appreciate you coming up here, man. And to everyone listening, we appreciate you listening. Please make sure you share this episode. Do you have anything left to say, bro?
That's it, man. That's it, man. We made it through the year. 2020 almost up. Just stay consistent. Keep working. It'll get better.
Facts, facts. Well, I appreciate you, man. And this is the Misguided Podcast where we intend to guide you to a better future. My name is Juwan. Again, sitting here with my homie Joziah. So we'll talk to you later, man.
All right.
All right, bro.